Namaskaram and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. Before the September 2021 relief package, telecom companies in India had faced a number of challenging years. There were mounting fears that the sector would effectively end up seeing a duopoly between Reliance Jio and Bharti Airtel. The year 2022 saw the much anticipated 5G auction, which opened up new avenues for telcos. But it also came with its own set of challenges. Overall, it seemed that the sector was on the path to recovery. Now, will that process continue in 2023 or will it end up losing steam? Bhaswar Kumar brings you the answer.
Looking forward to upgrading your mobile play with 5G this year? With blazing fast internet speeds and its features, from uninterrupted streaming to enhanced gaming, you probably won't be disappointed. But what about the telecom sector itself? What's in store for it in 2023? The outlook for the telecom sector may be that the ongoing 5G rollouts will deflate the industry's recovery with regard to returns on invested capital. Return on invested capital, or ROIC, is a metric that is used to assess a company's efficiency when it comes to allocating capital to profitable investments. The year 2023 will likely be defined by competitive 5G rollouts, delays in tariffs reaching adequate levels, and a battle for premium smartphone subscribers. This is the assessment of a recent JP Morgan report on the 2023 outlook for Indian telecom. The report points out that Jio has turned its focus from entry-level to premium subscribers, which is likely to deflate pricing at the premium end and lead to the return of a more competitive pricing regime. Jio's shift, which is meant to drive greater monetization in 5G, will likely mean higher capital expenditure for Airtel as it tries to defend its share and competitive pricing for 5G plans, which will then lower its free cash flow and return on invested capital. Free cash flow means the cash a firm generates after factoring in cash outflows for supporting operations and maintaining capital assets. The JP Morgan report also sees hesitance on the part of telcos when it comes to going in for tariff hikes. This is because consumers are unlikely to support tariff increases amid the prevailing inflationary environment. Meanwhile, telcos are focused on onboarding 5G customers. The upcoming state elections in 2023 and the 2024 Lok Sabha polls may also delay tariff hikes. According to a Jefferies report, there is greater uncertainty on tariff hikes in the near term because the large capacity creation, thanks to 5G, will shift the focus of telcos to increasing utilization. The focus on increasing market share will also rise amid moderating data subscriber growth and Vodafone India's worsening situation. On the other hand, in the longer term, average revenue per user, or ARPU, in India could rise at least 30%, given the country's low ARPU per capita GDP ratio. ARPU is the average amount of revenue generated by each active user over a given period of time. The report also says that Jio will favor higher tariffs before its potential IPO in either 2024 or 25. The Jefferies report also indicates that 5G is unlikely to drive up ARPUs without tariff hikes, and that its rollout would lead to higher network costs and selling, general and administrative expenses, which could prove to be a drag on the margins of telcos. Overall, the JP Morgan report says that the combination of higher than expected capital expenditure, delayed price repair, and a lack of 5G monetization should halt the sector-wide recovery with regard to return on invested capital. In fact, it expects the situation in this regard to either decline or flatline over the course of the remainder of FY23 all the way up to FY25. As a consequence, JP Morgan has downgraded Airtel from overweight to underweight. A Bank of America Global Research report also recently said that more pronounced competition and higher capital expenditure would be the challenges in 2023, while downgrading Airtel to underperforming from neutral. The third player, Vodafone India, also continues to face headwinds. A government official recently said that its promoters were unwilling to infuse adequate capital into the telco. As a result, the government felt that converting the accrued interest on deferred adjusted gross revenue dues into equity had become unviable. The promoters, Vodafone plc of the UK and the Aditya Birla Group, are reportedly willing to infuse up to 3,000 crore rupees into the telco, while it needs around 45,000 crore rupees for sustaining itself. The source cautioned that it would be difficult for the telco to get external investors in the absence of promoter funding, and added that even banks were unwilling to support the company under such circumstances. In 2021, the centre had cleared a relief package for the financially stressed telecom sector to prevent the industry from slipping into a duopoly. As part of the package, telcos were given the option of converting part of their interest dues into government equity, and Vodafone Idea had opted for it. All of this raises the question, will the recovery that was underway in the telecom sector continue in 2023 and the coming financial year?
The recovery in FY24 will continue from a top-line perspective, but if you were to look at the overall margins, I think there is going to be significant pressure on the operators. Where the stress is going to come from is because all the operators have spent significant amount of money in terms of 5G rollout, and we're seeing a large number of cities where 5G rollout has happened. The 5G rollout is really not helping give a boost to the top line of the operators. It is not adding to the overall ARPU from the subscribers. And hence we believe that all the operators are going to be under pressure when it comes to the overall ROI. I think in the next 12 months, the overall capex investment by the operators is going to be very, very significant. And some of the reports have suggested that over the next 2-3 years, it's almost 120,000 crores that are going to be pumped into the sector. Hence, obviously, there is going to be a challenge in terms of cash flows. Operators will have to identify means to be able to pump in that kind of a money into the system to be able to roll out the networks.
The Supreme Court's decision on the AGR issue created a huge liability for private telecom players. It posed a huge threat to their cash flows. Fortunately, the government's relief package has helped with relieving some of that pressure. The telecom sector otherwise has actually been doing rather better. The ARPUs have certainly increased quite significantly. It's true that the subscriber numbers have fallen a bit, but that could easily be misleading because given the rising price of telecom services, a lot of people are now keen not to have multiple SIMs. So the issue for the telcos and for the sector is the sector's revenues. And those revenues are increasing, not decreasing. And I think that should give us some comfort about the health of the telecom sector going forward.
As part of its recommendations for the upcoming budget, the sector is reportedly batting for a reduction in levies, including license fees, and seeking a tax credit refund of 32,000 crore rupees to enhance its financial viability. While the government weighs the merits of these recommendations, it must at least consider that the objective of its 2021 telecom relief package will be lost if it fails to stick to its stand on converting Vodafone Idea's interest dues into equity. It may be a good starting point to secure the sector's future.
Not just telecom, other sectors too are expecting some relief from the upcoming union budget. The economy has opened up, people are traveling like they used to before the pandemic struck, the consumption is rising, and the demand for bank credit is also up. So will it lead to the start of an investment cycle? Tushar Verma reports.
Medical experts from 3 leading health institutions of the country, Indian Public Health Association, Indian Association of Preventive and Social Medicine, and Indian Association of Epidemiologists, have said in a report that it was high time to declare an end to the pandemic. On January 12, there were just 2,309 active COVID-19 cases in India. The movement of people is also nearing the pre-pandemic level, suggesting economic revival. According to a Business Standard report, the Indian Railways had recorded 76% year-on-year growth in its passenger revenue in the first 8 months of this financial year. The national transporter garnered Rs 43,324 crore from its passenger services until November against Rs 24,631 crore in the corresponding period last year. Unreserved tickets have garnered 422% more revenue between April to November as compared to the previous year. So it all suggests that railways are back on track. While experts said that the rise in revenue can also be attributed to the hike in fares, they all agreed that the footfall has certainly increased. In September 2022, the daily average ridership of Delhi Metro touched 87% of pre-pandemic level. The DMRC-operated metro has been running at 100% capacity since February. Meanwhile, the average daily ridership for local trains has crossed 40 lakhs on Central Railway and 30 lakhs on Western Railway, just about 5 lakhs short of the pre-pandemic level. Officials attributed this shortfall to hybrid work arrangement. Traffic has also increased in the sky. In fact, airports are brimming with people holding plastic trays and waiting for their turn. According to a CareEdge ratings report, air passenger traffic will hit 93% of pre-pandemic levels in FY23 and surpass pre-COVID levels in FY24. So what does this increased movement of people mean?
Along with the traveling, certain amount of spending automatically comes. Whether this will translate into higher consumption, that is still something not very much feasible and cannot be linked with the increased travel. For the simple reason that, the high inflation of last several months have actually eaten into the household's earning. I mean, in fact, their real income has been severely hit.
According to an RBI report, bank credit grew by 17.5% year-on-year to Rs 131 trillion in fortnight ended December 2. It suggested continuation of firm demand for loans in the economy. SBI expects corporate loans to grow at an average of 12% over the next 2 financial years. But will it sustain?
See, if you're looking at 22-23, we have seen definitely a rapid growth in bank credit. Now, to my mind, there will definitely be a slowdown in growth in credit. There are 2 reasons for it. One is that we all agree that there's going to be an economic slowdown in 23-24 on account of the global recession. We're all talking in terms of growth slowing down from 7% to something like 6 to 6.5%, which means that there will be less credit offtake. Second, we have seen that the RBI has been increasing the repo rate. And if monetary policy has to work anywhere in the world, it necessarily has to lead to a slowdown in growth and credit.
A poll conducted by Business Standard of 35 CEOs showed that Indian companies are planning to increase investment, acquire companies, and go on a hiring spree in the calendar year 2023. However, they also cited hindrances such as increasing interest rates, rising costs, and weak consumer demands. Inflation, which fell slightly towards the end of CY22, was also cited as a hindrance. Almost all the CEOs in the poll said they had high expectations from the upcoming budget. So will the investment cycle pick up?
So this is what is still worrying a lot of private corporate investment, that even while the recovery is on, they are still not confident whether this recovery is here to stay. They are certainly in a position to undertake the capex, but they are sitting on the fence. They are just waiting and watching, how things pan out. The companies are not investing in new capacity. They are not coming with new factories. But at the same time, to say that they are not undertaking capex would also be wrong, because even to run the current factories, they have to undertake what is called maintenance capex. So that in any case is continuing.
Apart from consumer demand and private investment, there are other factors that will affect the economy. The Russia-Ukraine war, rise in crude prices, and global slowdown are playing a spoil sport. Global as well as domestic inflation was on the rise till a few weeks ago. Kristalina Georgieva, Managing Director of International Monetary Fund, has warned that a third of the global economy might face recession in 2023. She said the major factors behind a possible recession was slowed economic growth of the EU, China, and the USA simultaneously. So how will it affect the economy in the days to come?
Where we get affected is basically in terms of exports. So tomorrow, if we're talking of a recession which is going to take place in most of the Western countries or even an economic slowdown, there will be less demand for our exports. And that's where I see a kind of a definite shift in terms of the movement of growth in aggregate demand. Besides this, we'll also see the impact in terms of overall flow of funds, where there would be foreign investment in particular, is something which needs to be seen as to how it works. With FDI has already shown signs of a slowdown. There could be a further slowdown in 23-24. FPI will continue to be as whimsical as ever, but definitely there will be a fewer reservoir of easy funds available for investors to invest in emerging markets.
According to estimates of the National Statistical Office, the Indian economy may grow at 7% in FY23. This is higher than the RBI's estimate of 6.8%. Estimates from several agencies and the World Bank have put India's GDP growth at more than 6% in FY24. This comes around the time when the IMF has pegged global GDP growth at a mere 2.7%. Ratings agency S&P Global has forecasted a contraction of 0.1% in US GDP in FY23 and 0% growth in EU. While passenger numbers across railways and airlines have increased amid the reduced threat of COVID-19 and in the absence of renewed restrictions, there may not necessarily be a corresponding increase in consumer demand. Household incomes were impacted last year as inflation remained above RBI's upper tolerance band for most of it, and sticky core inflation remains a worry. As such, India Inc. could continue to sit on the fence as far as making significant fresh investments is concerned.
The IT sector was one of the key driving forces behind India's healthy economic growth. It is set to pass the earnings baton to banks as the season enters its second leg. HDFC Bank will kick off the sector's results with the numbers on Saturday. Analysts feel the pack as a whole is expected to see best-in-class results this quarter, with public sector banks faring better than private peers. The key, however, will be sustainability of the trend in the quarters ahead. Nikita Vasisht brings you more on that.
India's financial sector is all geared up to report the October-December or the festive quarter earnings. Private lender HDFC Bank will start the season with its results on Saturday, January 14th. This will be followed by ICICI Bank, Axis Bank, IndusInd Bank and State Bank of India in the forthcoming weeks. Analysts believe Q3 earnings during the ongoing financial year may be the best for the pack in recent years, with asset quality concerns far behind and margins expanding for most lenders.
Banks will witness another strong quarter, probably the best in the last many years, as we will see improved numbers across. NIMs will increase by about 10 bips, with NII rising about 5%. Asset quality will see further improvement, especially in the PSU banks, and loan growth will sustain around 18% YoY, whereas deposit growth could in fact lag and be below 10%. Though PSU banks may see some wage hike provisions, but PAT growth on an average should be over 40% YoY. Management commentary will be closely watched for their view on rate hikes and when they see the rates peaking out.
Pankaj Agarwal of Ambit Institutional Equities too said that Street's focus will be on margin expansion and outlook.
Given that growth and asset quality for the sector is going to be uniform across the sector, I think focus of the investors will be on the margins, more about the sustainability of the margins, because some banks which will report expansion in margins might not be able to maintain those margins in FY24. So I think the focus of the investors will be at which banks will be able to maintain their margins in FY24.
In absolute terms, Bloomberg consensus estimate pegs net profit growth at 42% year-on-year at 56,786 crore rupees. The net interest income is expected to grow 17% YOY from 1.68 trillion rupees last year to 1.98 trillion rupees. These estimates are for 18 listed lenders, including 6 public sector and 12 private banks. Analysts say the stellar Q3 show is already priced in by the markets. Data by Ace Equity shows that public sector banks outperformed the markets during the October to December period. UCO Bank, Punjab and Sindh Bank, and Jammu and Kashmir Bank more than doubled investors' wealth during the quarter, while South Indian Bank, Indian Overseas Bank, Bank of India, and UBI jumped between 80 and 98%. Among the private lot, Yes Bank and Axis Bank advanced around 30% each. HDFC, ICICI, IndusInd Bank gained between 3 and 14%. By comparison, the Nifty Bank Index gained 11% during the third quarter, while Nifty 50 moved 6% higher.
Overall, I believe the great earnings are already discounted during the recent rally, and any disappointments could see major cuts. Secondly, this could remain the best quarter in recent times, with performance peaking out with a lower Q4.
As regards today, investors will react to the retail inflation data of India and the US, along with the earnings report card of Infosys and HCL Technologies. Investors will eye Wipro's results on Friday and HDFC Bank and Avenue Supermart's results on Saturday.
Meanwhile, a warning from the World Health Organization has stirred a debate around alcohol consumption. WHO has said that any amount of alcohol may have adverse ramifications. We bring you more on that in our Decoded segment.
The World Health Organization recently said that there is no safe amount of alcohol for consumption. Even a small drink can increase the risk of getting cancer. In 2020, 740,000 cases of the disease were directly linked to alcohol consumption. Its earlier research found that alcohol increases the risk of at least 7 types of cancer, including bowel cancer and breast cancer. Even the International Agency for Research on Cancer has classified it along with asbestos, radiation, and tobacco as a high-risk carcinogen. WHO also said that disadvantaged and vulnerable populations have higher rates of alcohol-related death and hospitalization. This is because the ill effects from a given amount and pattern of drinking are higher for poor drinkers and their families than for richer drinkers in any given society. Despite years of research, according to WHO, there are no studies to show that alcohol offers any benefits related to cardiovascular diseases or type 2 diabetes. On the other hand, there is evidence to show that even occasional drinking may lead to a rise in the risk of these diseases. The risk of cardiovascular diseases rises more than others. The National Family Health Survey 5 showed that the consumption of alcohol has gone up in India in the last 3 decades. Currently, around 79.9 million men and 5.39 million women consume alcohol. It is higher in rural India as compared to urban India. Among all the states, Arunachal Pradesh has the highest proportion of drinkers. 1 in every 2 people in the state consumes alcohol. It is followed by Telangana and Sikkim. On the other hand, Lakshadweep has the lowest proportion of alcohol consumers in the country. It is followed by Gujarat and Rajasthan. NFHS 5 also said that in religious terms, the highest number of consumers of alcohol come from other religions. It is followed by Christians and Buddhists. WHO suggested that, like in tobacco products, cancer-related health information should be displayed on the labels of alcoholic beverages as well. It highlighted the need to have trained health professionals who feel comfortable informing the patients about the link between alcohol and cancer. Moreover, wide awareness of this topic in countries and communities is also required.
I will achieve, I will fly high. nation's trusted bank, SBI, the banker to every Indian.
And so the debate continues. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll see you on Monday morning. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.